Welcome, guys, to another episode of Parvez's Trade. And on this episode, I'll be talking. So this will be multiple parts series, and on the topic I want to cover on this playlist is basically regarding forward and futures contract and how they're shaping the global financial markets. And yeah, so for those of you who don't know, I have a background in trading, and so my role for this channel is basically to educate the world about how the financial markets work, geopolitics, and yeah, making some predictions on what the future looks like. But yeah, the next few episodes will be focused mainly on making you guys understand how the forward and futures market has changed all the financial markets around the world. And yeah, so let's get to it. So well, first of all, when we talk about forward and futures, I'm not going to go into much detail what they mean, what the differences are, but just to give you guys an idea in simple terms, we are a forward or futures contract simply means that you're buying the right to you're buying the right to buy or sell an underlying asset at a predetermined price at a specific date in the future, right? And so a simple example would be if you buy, let's say you buy a forward or futures contract in the oil market at $100. Okay. I don't want to get into the terminologies and the keywords, so I'll just keep it simple. So a futures contract would look something like basically your oil contract will determine that you have so if it's a buy contract or a sell contract, let's say it's a sell contract that you buy, and that sell contract will basically obligate you to sell the oil, the amount of volume of oil, at a specific price at a specific date in the future. Okay, and try to understand what this means. So, before this futures market existed in the past, how would the financial markets work, right? You have supply of a underlying asset and you have demand for the asset, and that would basically the supply and demand would basically determine the price, right? Whether forget oil, let's think about the stock market. Okay, there's a limited number of shares of that stock in the market. Okay, so if the demand for the stock increases, but the amount of sellers of the share of the stock stays the same, but there are now more people willing to buy the stock, that will increase the price, right? So that's similarly in oil markets. If you're trying to buy oil, the supply of oil is stable, but the demand increases, then price will increase, and vice versa, right? That's usually how financial markets used to work. They were very simple. But then people started introducing this forward and futures market into the commodities market, especially. And it started with this market in Chicago, where this futures contract started trading. And the initial idea behind it was to basically uh, hedge against any price risks. And so, yeah, to keep it simple, let's say you are cattle. Okay, you have a ranch, you have you sell beef, and so you're trying to negotiate a price for your beef, right? So you have a cattle ranch, and you have a bunch of cows, so you have to raise them before you can sell them, and it might be a few years from now when you'll have to sell them. So how do you determine as a rancher that you'll get a fair price for your cattle when you sell them in a few years? Well, you go to the futures market and you basically buy futures contract. So to keep it simple, let's say that a pound of beef meat is right now selling in the futures market 3 years from now for $10 a pound, $10 a kilogram. So what does that mean? So let's say your cost of raising the cow and then selling it, your cost of selling the beef is, let's say, $8 a kg, a kilogram per kilogram. And you can now go into the futures market and buy a futures contract for beef at $10 sell. So you'll buy a sell contract, which basically obligates you that, let's say, the delivery period is 3 years from now. So that contract will basically obligate you to sell beef at 3 years from now at $10 a kilogram. And you buy that sell contract. What do you do? What has happened here? You basically locked in a bit of profit, and also uh, basically you have positioned yourself against any future drop in beef price, right? Now let's say 3 years goes on, and now the price of beef in the market is $7. You can then exercise your sell contract and just sell your beef for $10 per kilogram. And you don't have to sell it at the current market price of $10, $7 3 years from now, let's say, right? And let's look at another situation. So now it's 3 years from now. You have a sell contract for selling your beef at $10 per kilogram. But now the market, the current market price is now $15 per kilogram, right? Okay. What do you do? Okay. So I have a sell contract. 3 years has expired. I am now obligated to sell a specific volume of beef meat at $10 per kilogram. I have to honor my contract or I get penalties. Cool. What do I do? I can sell my beef to the market at $15, but then I will not be able to honor my sale contract at $10 per kilogram. What do? I go to the market and I see and this will be just before, maybe a few months before the 3 year contract comes due. So let's say right now it's 2024, okay? So in 2027, okay, you're supposed to deliver beef of a specific amount at $10 per kilogram. Then 2025 comes around, 2026 comes around, and now the price of beef in the market in 2026 is already $15 per kilogram. So you're expecting, okay, beef price has been rising and it has gone against my prediction. And next year, 2027, beef price will be likely above the price that I'm supposed to sell according to my sell contract in 2027, right? So 2026, current beef market price is $15 per kilogram. You have to sell your beef in 2027 according to the sell contract at $10 per kilogram. You are expecting in 2027 beef price to be above $10 per kilogram. What do you do? What do you do? Okay, I have to honor my sell contract in 2027. At the same time, I want to make more money by selling to the current beef market price, which is likely to be higher than that next year in 2027. So what do you do in 2026? You go to the futures market for 2027. You buy a buy contract or a long contract. You buy a buy contract for 2027. You see the price of that. Okay. And if that price is, let's say it's now 2026, you go to the futures market and you're trying to buy a buy contract for 2027 delivery. And the price is, let's say, for $8 per kilogram. Okay. So you buy the buy contract for 2027 delivery for $8 per kilogram, and now your futures position is zero. So you don't have to deliver anything, if that makes sense, right? So let's say I'm supposed to deliver 100 kilograms of beef at $10 per kilogram, according to my sell contract for 2027. It's 2026, and the dynamics have changed, and now I want to buy off that position because I want to deliver at the current market price, which is far higher in 2027, likely to be far higher. And I go to the futures market for 2027. I buy a buy contract for 100 kilograms of beef at $8. I net a profit of the difference of $2 per kilogram. And the actual beef that I have, I can sell to the current market price in 2027, which is likely to be above $10 because you've been seeing that prices have been increasing. What about in another situation? Let's look at it in some another way. So basically now you're in 2026. You want to close off your futures position. You have a sell position for 2027, 100 kilograms of beef, $10 per kilogram. I want to close it off. I believe I can make more money by selling my beef to the actual market in 2027 because beef prices has been rising the last few years. I want to close off this futures position. I want to buy a buy contract and balance out my futures position. I go to the futures market in 2026 and I look at the futures market price, buy price for 2027 delivery. And right now, the market price is at $12 per kilogram buy contract for 2027. What does that mean? I can buy beef at $12 per kilogram for 2027 delivery. If I buy 100 kilogram worth of that contract, my futures position is closed, but now I've netted a net loss of $2 per kilogram, right? I bought a futures sell contract at $10. I am now buying a buy contract to close the position at $12. So I've made a loss of $2 per kilogram or $200 for 100 kilogram, right? And what does that mean? That means I'm expecting in 2027. So we're in 2026. I've closed off my position for 2027 futures contracts. Now I'm expecting to sell in the 2027 futures. Sorry, in the 2027. Yeah. So as I was saying, so now it's 2026, and so where were we? So yeah, so it's 2026. You want to close off your futures position for 2027, and so you had a sell contract to sell in 2027 for $10 per kilogram. And now you have to close off that position because you believe you can make more money by selling your beef in the current market in 2027, not in the futures market. And so you buy a buy contract for 2027 delivery, and you see the price at $12 per kilogram. You do that, you close off your futures position, you make a loss of $200 for 100 kilograms of beef. And what the only way time you do that is if you expect in 2027 you can sell 100 kilograms of beef at current market price and make a profit more than $200. That makes sense. If you're just by opening and closing your futures position and not having to deliver anything and not being penalized, you make a loss of $200. You have to make a profit in 2027 by selling your 100 kilograms of beef in the current market price, and you have to make a profit of more than $200. And so you see how the dynamics now change in the financial markets if you think like that. And this is also an important time because this is where the idea of the short squeeze comes into play, where traders have to basically they make a wrong bet in the futures market and they have to basically buy back their position in the opposite way, by buying in the opposite direction by buying a contract in the opposite direction. And as a result, they drive up the prices artificially. There's no actual, you know what I mean? Like in 2026, when you just bought up these futures to balance your futures position because you can make more money, you think, by selling at the current market price. The fundamentals of the beef market hasn't changed, if you think about it. Okay, the only thing that has changed is your futures position is now zero. Okay, when you bought up those contracts, buy contracts to close your futures position, the fundamental supply and demand of the beef market has been same. The only thing that has changed is you buying up those buy contracts for 2027 to close your futures position because you think you can make more money by selling at the current market price in 2027. And just by buying up those buy contracts, you're driving up the prices. And this is where the idea of the short squeeze comes into play, especially in stock market. We heard about that in during the GameStop short squeeze in 2021, where basically traders make a wrong bet in the futures market and then they have to close their position by buying up a contract in the opposite direction, close to and they'll usually do it close to the initial contract's expiration date. And because you have all these traders demanding to buy back their contracts in the opposite direction at a specific time close to expiration date, that just drives up prices in the opposite or lowers prices depending on which direction you're buying the contract from, right? And that's how these futures and forward markets have completely changed, most of the financial markets around the world. Get that? And so no more you have a simple financial market, where the price is determined by supply and demand and basic fundamentals. Okay. And yeah, so I just wanted to talk about it and just to give you guys an idea of what it means. In the next video, I'll get into more details of how you can make money by just understanding this concept and yeah, how you can identify trends in the markets that are occurring as a result of this futures and forward trading. And yeah, that's it for me for this video, and I'll see you in the next one.